Welcome back to our special market show, the market editor. And of course, our market editor today is Ramdev Agarwal of Motilal Oswal Financial Services. We also now have Pranav Haldia, Rahul Saraf and Feroze Azeez with us.
Feroze, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question, on the previous topic, I have three important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. And largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point one. Point two, if I personally think that there's hardly any promoter selling in NSE 500 companies. Let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% promoter, it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies, top 5, the fifth top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling. And that's project is viable at equity. You don't need debt for it. So that's why you see they're deleveraged. One point I want to make on that thing, like the moment has come after a couple of decades. The great part of this moment having come a couple of decades is the other moment on the other side, the buyer side has also taken a couple of decades. What is happening today, I was just doing a study on one of our digital platforms. The retail investor, the hypothesis is the retail investor is no more seeing the domestic mutual funds as an investment vehicle at all. He's seeing it as a savings vehicle. By which I mean the frequency at which a retail investor is opening his SIP values and checking it has fallen almost 1/100th. 5 years back, he would open his app to try and check whether am I making money. Now he is just parking the money and not worried about the value. That's why in 2 years, when Nifty did nothing, October 21 to October 23, Nifty was exactly 18,500 on both these expiries. But the SIP number went from 11,000 crores per month to 19,000 crores per month. A decade back, where you collected 18,000 crores in the full year, if there were 3 bad months of the market, SIP numbers would drop 30%. In 2 years of sideways movement, if the SIP number could go up 80%, it's one of the indicators of the hypothesis that the saver is also now seeing it as a savings vehicle like gold. He doesn't check the price once he buys gold. He buys real estate, doesn't check the price. Now he's buying equity, not checking the price. Unlike the HNI, that's why HNI is selling whenever he should buy. And the retail, ironically, is far sharper and mathematically provable over the last 4 years. And your net flow from FIIs from FY21 is zero. From domestic is 15 lakh crores, almost 7 times more. So I personally think both the moments have come together.
Thank you once again for joining us here, Feroze. Great that you could come down. Appreciate your time here.